Chinese stocks are surging again. The Hang Seng index is up 37% this year. The CSI 300 is up 21%, and the NASDAQ Golden Dragon China Index has surged 31%. After years of underperformance, Chinese stocks are suddenly leading the pack. But here's the question for fellow investors. Is this the start of a bull cycle? And which China-focused ETFs give you the smartest way to play it? Today, we're looking at 5 of the most important Chinese ETFs you need to watch in 2025, and how they stack up against each other. The rebound began in late 2024 when Beijing rolled out a wave of stimulus policies, from interest rate cuts to stock stabilization funds. Early in 2025, China also had its DeepSeek moment, putting the country on the global AI map. Pair this with cheap valuations, these factors have fueled one of the strongest rallies in years. Goldman Sachs and Nomura remain overweight on Chinese equities, calling for double-digit growth potential in 2025. Even after this rally, valuations are still attractive compared to the rest of the MSCI index. There is also an enormous pool of domestic savings worth about $22 trillion. To put that in perspective, the entire market capitalization of onshore and offshore Chinese equities is about $15 trillion. With interest rates low, even a small portion of that savings flowing into stocks could move markets in a big way. At the same time, AI adoption is accelerating. Companies like Alibaba, Tencent, and Baidu have collected massive datasets on par with US peers. Their valuations are still fractions of Amazon, Google, or Meta, but the growth potential is significant. Add in a stronger, cheaper energy grid, and China looks well positioned to support its AI ambitions. Put it all together, and we may be looking at the early stage of a multi-year bull cycle. The Chinese stock universe is huge and complex. It includes A shares listed in mainland China, H shares listed in Hong Kong, and ADRs traded in the United States. Picking individual companies can be time-consuming and risky, especially with political and regulatory uncertainty. ETFs simplify that process by offering diversified exposure, handling currency conversions, and ensuring compliance. They allow investors to tap into the Chinese growth story without betting on a single stock. First up, CraneShares CSI China Internet ETF. KWEB focuses on China's internet and e-commerce giants. Its top holdings include Alibaba, Tencent, and Pinduoduo. This fund blends ADRs and H shares, and is the go-to choice if you want tech exposure. In 2025, KWEB is up more than 46%, making it a strong performer during the rally. Next, Invesco Golden Dragon China ETF. PGJ tracks only US-listed Chinese ADRs. Its biggest positions are Alibaba, Baidu, and JD.com. Because it is ADR only, PGJ skews heavily toward growth and tech. But it is also the smallest by assets under management at just $139 million, which raises liquidity concerns. The third ETF is Direction Daily FTSE China Bull 3X shares. YINN is the leveraged play. It offers triple exposure to Chinese H shares, which means triple the upside and triple the downside. It holds big names like Tencent, Alibaba, and China Construction Bank. In 2025, YINN exploded 105% higher, making it the top performer, but also the riskiest choice with extreme volatility. Coming up next is the iShares China Large Cap ETF. FXI focuses on large Chinese companies listed in Hong Kong, especially financials. Its portfolio includes Meituan, Alibaba, Tencent, China Construction Bank, and JD.com. This year, FXI is up about 38%, showing strong large cap momentum. It is a good option if you want exposure to Chinese banks and financials. Last but not least, SPDRS&P China ETF. GXC is the broadest fund, covering ADRs, H shares, and A shares. It balances exposure across industries, with consumer discretionary making up the largest share. Top holdings include Tencent, Alibaba, Xiaomi, PDD, and China Construction Bank. In 2025, GXC is up 41% and has the highest Sharpe ratio, meaning it delivers the best risk-adjusted returns thanks to broad diversification. So how do they stack up? In raw performance, YINN wins with a triple-digit return, followed by KWEB's tech-driven surge. In terms of cost, GXC is the cheapest at a 0.59% expense ratio, while YINN is the most expensive at 1.36% because of leverage. Looking at risk-adjusted returns, GXC stands out with a sharp ratio of 1.36, meaning steady gains with relatively low volatility. KWEB and YINN have similar sharp ratios of 0.79, but YINN carries far more volatility at 65%. In terms of liquidity, KWEB is the largest with $8.5 billion in assets under management, while PGJ is the smallest and least liquid. Even though ETFs diversify company-specific risk, China exposure still comes with significant macro risks. A slowdown in growth, currency swings, or inflation could derail momentum. The US-China relationship also adds uncertainty. Tariffs, trade restrictions, sanctions, or potential delisting of Chinese ADRs could directly impact these ETFs. So which China ETF should you watch in 2025? If you want to maximize tech exposure, KWEB is your pick. If you crave high risk and high reward, YINN offers leveraged returns. If you prefer broad, balanced exposure, GXC is the safest long-term choice, though China's rally may still be in its early innings. With AI development and cheap valuations, the setup for Chinese equities is stronger than it has been in years. The question here is whether you see this as an opportunity to diversify your portfolio now, or a risk you would rather avoid. What about you? Would you add a China ETF to your portfolio in 2025, or stick with US equities? Let us know in the comments, and don't forget to like and subscribe for more insights on global investing. We'll see you in the next one.